Hey folks, welcome along to tonight's webinar. My name's David House and I'm here with Campbell Venning, who's just doing a couple of audio fine-tuning tricks to get his audio crystal clear. So we thought we'd just get started so that you know we are here and ready to go and good to go on time. So welcome along to tonight's webinar. And while Campbell's just getting himself plugged in and connected, my name's David House and welcome to the webinar. Tonight we're going to take you through a bit of an update on the market. I'm going to talk to you about some of the things you can do to help grow your equity faster and pay off your mortgage faster and all those kind of good things that happen when you're making money as opposed to just spending money. And we're going to profile some of the most recent projects we've got and talk a little bit about those, particularly one we released about 3 weeks ago now that's going gangbusters. And we'll tell you more about that during the webinar. So thanks for joining us tonight. And if you've got questions, don't hesitate to pop them into the Q&A toolbar, send those through. We'll take questions along the way, and we'll also we'll do a bit of a wrap up at the end and run through the questions as well, and read them all out for everybody to hear. So, Cam, just let me know when you're ready to jump in. Otherwise, I'll just continue with the formalities. Yeah,
no, I'm all ready to go, mate.
Excellent. Okay, so do you want to take over mouse control then?
I do. Okay, cool. Well, I'm just going to hit the keyboard to move things forward. So, hi everybody, and welcome to tonight's presentation. I just want to make sure my clickers are going to make this move forward. I can see your mouse, David, but not mine. Hang on.
Okay, sorry.
Let's get this housekeeping stuff sorted first, eh?
You take control, and it should just you should have the mouse from now on.
All right, here we go.
Okay, just click on the button here, approve. Okay, it's yours.
Oh, there we go. It's working. Right. Hello, everyone. Welcome to the webinar. Now, some of you have probably been to one of these before, so I'm going to rip through some of this stuff pretty quickly. But my name's Campbell Venning, and I am the founder of the Property Factory, and I guess I'm just a regular Kiwi guy, but I got into property early, and it's done some amazing things for me. It's taught me a lot about the law. It's taught me a lot about finance. It's given me a hell of a good lifestyle. But more importantly, it's created a business for me. I've been self-employed now for over 18 years from property. We actually got into it by mistake, and a lot of the people that I'm seeing in our customer base today, they don't know what they don't know. And property is an amazing beast, because if you get it right, and if you get it horribly right, it can change your life. And not overnight. It's not a get-rich-quick scheme. Property can be seen as doing that, but it doesn't have to be. It can be very slow and steady, wins the race, and it can change your life. It can make the difference between retiring off 50 grand to 100 grand to 200 grand to 300 grand a year in income. And that's the long-term goal with property. Anyway, I'll talk about that once I get into it. So I bought my first property in '92 with my girlfriend at the time, who's that beautiful woman in the middle of the family picture there. And we did that in Wellington, and for 10 years we were serial renovators. And the serial renovating turned into 27 odd years in the property industry. I've been a trader. Well, I am still a trader. I've been an investor. I am still an investor. I've been a developer. I spent 3 years in investment lending, and I've been in the agency world for 7 years. So I call myself a property guy. I'm currently what I deem a listing agency. I'm a trader and an investor. So every property deal is different. They're not all created equal. And we'll talk about that as we get into it. But I guess there's not much I haven't seen in property. I've been through 4 cycles. And I offer this experience and this wisdom to all of our customers, because the reality is when property goes horribly right, everybody holds hands and backslaps. But when property goes horribly wrong, it can be very expensive. It can be very dangerous financially. It can be very dangerous on your mental health. So, you know, properties, it's great and it's scary. And I guess what we have built here is a long-term, low-risk business for our clients. We'll go at their pace, but if we think someone's going too quickly, we'll put the brakes on them. And if we think someone's going too slowly, we'll tilt the slope a bit more to make them run a bit faster. So, you know, we really are passionate about what we do. The Property Factory has been a long time in the making, and we've had a fabulous 6 months in the market, working with some great people. And this last 6 months, because we've pretty much we've really only launched it about 6 months ago. So yeah, that's a bit about me. I'll get a bit more into the Property Factory. I guess it's a business where I did a thesis, like an MBA at Auckland University, under a program called Icehouse. And it was one of the best things I've ever done. And I'm a massive believer of continuing education. And in my travels, I saw all these developers who desperately needed sales, and I saw all these investors that desperately wanted to buy rentals. So it didn't make sense to me. And in previous businesses, I could always sell more, and we could always take on more clients. But the gap was speed, and it did my head in. You know, we had clients who were just mucking around to the point that they were just missing out on great deals. So we've created a very efficient model that enables us to get our clients into property quicker, still doing the due diligence, still doing all the homework, direct with the developer vendor through our, what I call a wholesale model. So we basically are a container door direct type parallel importing model for customers to get a better deal than they can get in the retail market, and for developers to get access to purchases that they would normally spend a lot of time and money, or time being a big one, getting, because most agents are what I call list and hope. Most New Zealand real estate companies get a listing and hope like hell they sell. And we don't work like that. We spend a lot of time with the purchaser, educating them on how and what they should buy, and then ensuring that they are in a position to buy, because we don't like putting our purchasers anywhere near our projects until we know, one, that it's right for them, two, they can afford it, and David's going to talk about how we do that later, and three, that it's the right property or properties for them over time. We got a lot of experience in the business. It's a members-only service. It has been built on a lot of traction. I think we're actually up to probably 2,200 transactions now. I've never actually, we started adding them up and it just took so long that, you know, we could be even 2,500, but, you know, we're over $1 billion worth of real estate now. So it's pretty exciting in terms of what we've done. And I guess that's the judgment, that's the experience, that's the wisdom that people get off the back of hanging out with us. So that's me, that's the Property Factory. If you've had you know, met us at one of our events, you'll know we're real life people. We're Kiwis. We love what we do. We've got a great team around the country now, and that's growing every month. We've been hiring people, and if you are a property investor and you want to get into a business, please contact us, because we're still hiring if you've got the right skill set. So that's a little recruitment plug. Send me an email, or send David an email, or just info. It'll make its way to us. So yeah, the Property Factory is what I call a wholesale listing agency, where I go and beat up vendors, developers, builders to get the best deal I can for my buyers, or for our buyers. And it works. So let's jump into a little bit of education and theory and strategy. So the other thing which I guess old school investors are struggling to get their heads around, but it is true, and it is happening. And that is the 21st century investing is changing. You know, old properties are getting older every day, every month, every year, to the point that this current government is putting serious regulation on investors, on landlords, to keep their houses as new as they can. And we have a very bad history here as a nation of investors. Kiwis are tight. They don't like spending money on their houses, especially if it's a rental. And there's serious risk in buying old properties. So it's got to be a hell of a story for us to take on a second-hand property. And I'm not talking about your home here, I'm talking about investments. And we have stock which is actually cheaper new in the suburb, where we've got new stock in a suburb where the second-hand stock on average is more expensive than the new. That's just crazy. It'd be about like buying the 2010 Honda for more money than the new one. It just doesn't make sense. Also, people are downsizing. They're not having 4 kids anymore, or even 3. And the size of housing is changing. As I said, the government's putting more pressure on landlords to be compliant from a health point of view, from a healthy living. And the other thing is, in my first 10 years, my girlfriend at the time, wife now, and I did 10 years of full-time renovating on the side. We still had day jobs until it got to the point that I needed to go full-time on it. But for 10 years, we basically renovated every weekend, the whole time we were there. We never actually had any time off. We were just renovating on the side. It just became a business on the side. And in those days, we'd get about $3 for every dollar we spent. So if we spent $50,000 on a reno, we'd get about $150 back. If we spent $20,000, we'd get $60,000 back. It was about 3 to 1. Same math today, I reckon it's about 60 cents. I don't know many people who factor in the real cost of renovating, including their time, who actually make money out of it. The market might make you money, but the actual added value to the property, it's a false economy. And renovating is a lot harder than it used to. And your emotions can convince you otherwise, but if you factor your time in, you factor your real costs, it's very difficult to make renovating work. And one thing you've got to remember, houses are like trees, they're like cars, they're like people. They get older. And trees take a long time to get older, as do houses, but wood has a lifespan. Concrete has a lifespan. And as time is passing and weather is on property, it eventually degrades it. And we forget that. And whilst we're a young country, some of our real estate needs to be bulldozed. So yeah, times are changing. So let's jump back to what we do and how we operate. We have what we call key sourcing strategies. Every property is different. Every purchase is different. And depending whether you're a first-time buyer, a first-time investor, a seasoned investor, a trader, or a renovator, which will try and convince you not to be, the properties you buy will vary. Everyone's got a different age, a different set of financial circumstances. Everybody's got a different risk profile. And we play to all of those strengths, because the last thing we want to do is put a conservative person into a more speculative play, or a speculative person into a conservative play. And we match properties to people's investment behavior and investment style and investment experience and investment knowledge. And we're pretty brutal with people, especially the ones that want to turn into property maniacs overnight. We will say, no, you're not ready. You don't know the basics. You know, you need to do property 101, 202, and 303 before you want to buy and sell 20 sections in Central Otago. So every product that we look at, we put it into a bucket from super conservative to super speculative. And we don't do very many speculative deals, by the way. We mainly do boring, easy, steady as she goes property that's going to appreciate over time and pay you in retirement. That's our goal. So we've got a whole bunch of examples on our website. You know, the practice is in the preaching is in the practice. We have done a lot of deals, and we show them on our website, or some of them, not all of them. And whether it's a 10% return or 20% return or 37% return isn't the point. This is our track record. This is our CV. And I guess the one thing I recommend you do before you pay a mentor or a coach for property advice is to ask them what they've done. Because, you know, I turned 50 this year. David turned 50 this year too, I think, or last year. Well, no, he's next year, isn't he? You know, for a couple of 50-year-olds, we've got a lot of runs on the board. And I think in terms of wisdom and knowledge, you can't buy that. You can't pay for that. You know, you might have a guru property coach, but they're not going to tell you and show you everything they do, because there's just not enough time. So, you know, we have different strategies for different people. We can explain that to you when you come and meet with us. But I guess if I look at our real DNA, it is this slide here. When we're looking at a deal, we put it through an absolute ringer. We put it through filters. We put it through a due diligence process that includes looking at the developer's balance sheet, looking at the developer's background, looking at the developer's track record, looking at the developer's ethics and their team around them. You know, I've sat in many meetings with council and developers to help them get a design approved or a resource consent approved. And it's only because, one, I've been a developer before, but two, sometimes developers don't come across all that well, and they need people like us to really help them put the story to council that, yes, we do need these 30 units in this location because there's a shortage of accommodation that's new. So we look at a lot of different things that not your standard agency would do. And the number one thing that we look at is obviously location and product. And that's where we often get involved with a project early and we tweak the design, because not all architects are created equal. And in the investment world, it's not about how pretty the building is, it's the return. It's the cash on cost return. It's the long-term forecast for the location. It's the market timing. It's the quality of the specifications going into the property, the historical area. This is just 8 of our about 25 different selection criteria that we use when it comes to picking location, product, property type, developer, etc. Now, number 2 is a really important one, and that's infrastructure plans. If you look in Wellington, if you're sitting in Wellington tonight, when Transmission Gully opens up, that Kapiti Coast is going to be a whole different kettle of fish. And we're working with some builders at the moment to get some very, very well-priced off-the-plan projects up the Kapiti Coast. Same for the Wairarapa if you're still in Wellington. If you're in Hamilton, those ring roads between South Auckland and Hamilton and the proposed train stops in a couple of locations are going to have a huge impact on a couple of towns and suburbs around the Waikato. And again, we look at all of this stuff well out. You know, if you look at Rolleston, it was extremely predictable based on the government and the Carter family's plans for that Christchurch suburb, which used to be, when I grew up in Christchurch, blink and you miss it town. You know, it might have had 500 people if on a good day, and it's one of the fastest growing boroughs in New Zealand at the moment. And that's all because the Carter family kicked off the growth of Rolleston with the inland port, and when they invested $500 million, $500 million into the Rolleston inland port. So that's the sort of boring stuff that we look at, because we want to know, well, how many people are going to live here in 10 years' time? Where are the jobs going to be? You know, you don't want to be in a location in Tin Pot Town with one employer. That's not where you want to be. So infrastructure plans sound boring. It sounds like economics, but the reality is that's what's going to give you tenant sustainability, rental growth, capital growth, etc. So we look at a lot of government plans that get put through Parliament, that get put through Transit New Zealand, that get put through Council, that get put through Treasury, because when you know what's going to happen in advance, it gives you an opportunity to get in early. The best one of these that I can give you is Wanaka. We got an in on North Lake Wanaka before the market, and it paid myself and our clients handsomely. We were in the very, very first, I was the first purchaser in that subdivision, and we have been, I'm still involved in it. I've got another 6 houses coming out of the ground next year there. We've got 4 being built at the moment. Anyway, it's a subdivision in Wanaka, and if you look on our website, you'll see that the stats are pretty exciting. So we got into that in stage 1, and they're up to about stage 15 now. And we've got other subdivisions like North Lake Wanaka that we're working with developers on, so that clients like yourselves can get in nice and early. But it's not just throw the dart at the dartboard. We have a lot of we spend a lot of time and spend a lot of money on research. So infrastructure plans, all those things there. But the last one being experience and judgment, that's also mission critical, because we have been here before. We've seen cycles before, and sometimes a new development can look great, but it's the small things that can sometimes kibosh it. So we've moved a lot in the last few years as a country and as a business towards off-the-plan purchasing. Why? Well, first of all, the Reserve Bank has pretty much told the country that our housing stock's pretty tight and we should be upgrading it. And by the way, it's not economical to renovate. So we have literally pretty much excluded secondhand stock. It's got to be a damn good deal for us to look at if it's secondhand. And I look at some. I haven't really picked anything recently because it just doesn't stack. So you're better to buy off the plan in general. And this is why. Typically, your prices at the beginning are the cheapest, far more expensive when it's just finished, and prices go up as something's being built. Secondly, you don't want to be a developer. Okay, that's a hard business to be in. And they take the risk on variable costs, on labour costs, on inflationary costs. You're getting a price today, and it's locked in for a number of months, a couple of years if it's a big project. So the huge risk, the factor that the developer's taking on, and your only risk is market risk in the event the project stalls or falls over, but you'll get your deposit back. So under New Zealand law, post the global financial crisis, they changed the rules around deposits being held or released. And, I haven't heard of anybody losing deposits since the global financial crisis. And again, we try and avoid projects that stall or fall over. And it does happen. You can't predict everything. So we try and get the inside knowledge, inside word on all projects so that you are going to get capital growth before completion and buy at that stage one or in that rising market like Bridesdale, Queenstown and North Lake, Wanaka, which were two of the projects that we were involved in the last few years. These are just some of those deals on our website. Again, this is all on, you can look this stuff up, but these are deals where this is a trade where we bought 4 units at the same time and got $70,000 off each unit. But we had to commit to 4 purchases to get that deal. Here's another one. This is in Queenstown. These were house and land packages that we put together for our customers. We came in at the end of this project so that the margins weren't quite the same as North Lake Wanaka. We picked up the last 14 sections in this project, and all of our clients, I think the best gain was over 200, but the average gain was about 126,000 from the time they went unconditional on the land until the house was built. And, it took 2.5 years for that to happen, but that's still pretty good paycheck in 2.5 years. This was a while ago in Wellington. We were buying these properties so cheap at the time. It took 2 years to build, and on completion, there was 130K per unit in equity gain. This was a one-off in Queenstown. This was a trade in the end. We bought this to turn it into short-term visitor accommodation. It was 2-bedroom, 2-bathroom. And we spent quite a lot of time converting it to 3-bed, 3-bathroom. And when I say time, doing all the plans, talking to builders, getting quotes. And then the market went crazy. And I told my beloved wife that, sorry, my dear, but we won't be renovating this now because the market's gone too crazy. And in 1 year, it went up in value by nearly $300,000. And we sold it at auction. There were 18 bidders. So sometimes it just makes more sense to sell than hold, and this was one of those times. But again, that's if you're a trader. It would have been perfectly acceptable to keep this and convert it from 2-bedroom, 2-bathroom to 3-bed, 3-bath. But as I said earlier, it would have cost me more than I expected. That would have annoyed me, and that's when my trading hat kicks in. So look, there's heaps of these examples on our website. We've been involved in Auckland, Hamilton, Tauranga, Wellington, Christchurch, Queenstown, Wanaka, Cromwell. There's not many areas that we haven't been involved in the country. And, we have very strong views on the market in New Zealand, and I'm going to touch on that now. We'll be updating these slides probably in the new year. It's been not much has changed in the last 6 months in the New Zealand property market. She's been pretty steady as she goes. And But one thing is happening, and that is immigration is still strong. Interest rates are still low, and LVR restrictions are still in place. And there's talk about them changing, and there's talk about interest rates moving down, moving up. I read different articles every day. But the one thing that hasn't changed is that we still have a huge housing shortage. And the regions are at different stages. Wellington's going gangbusters. The acid's come off a little bit in central Otago. Certain pockets of Auckland are doing very well. Other pockets are still going a bit slower. But as the New Zealand's economical powerhouse, Auckland's still a strong location. Certain areas, prices are very high. Other areas, the infill housing, the Auckland Unitary Plan is now finally seeing smaller properties being built at lower prices, which is great for the long-term average in Auckland, coming down. And, we're going to see more and more of that over the coming years. Government is forcing investors' overheads up, and there is a demand from second-hand to new. And we're all of the view, when I say we, people in the industry who know people in the banks, know people at Reserve Bank, know people at Treasury, we're all of the view, and we meet monthly to catch up with different groups, that institutional money will start getting into residential property eventually. The finance topic is a really hot debate at the moment around property, because in the world of finance, we've got the lowest interest rates ever in New Zealand, but the banks are almost, it's almost the same climate where we've got the hardest conditions to get money from the banks. So we've got this huge housing shortage, we've got the cheapest money out, but the banks are very loath to give it. So whether they're nervous, whether they're concerned, we don't know, because a lot of that policy comes from Australia, and there's some parts of Australia that have been quoted as overpriced. But the one thing I'll say about New Zealand, and our banking system is pretty solid. The banks want to lend, but they've got these very, very rigid rules on them around lending, which it's making it very, very hard to get money out. So what we're seeing now is a huge, huge increase in what is called secondary debt markets. And we'll talk about that later once David starts talking about the numbers. But the reality is finance is a problem at the moment in New Zealand, and a lot of people are moving money out of the bank because the returns are so low, and they're putting it into property. So we're starting to see peer-to-peer lending hitting property. So there's a bit of change going on, and the institutional money buying land and building apartments and keeping them is something I'm starting to see more of as well. So I'm going to stick with a couple of things now. This is the small bit of education for the evening. And when I say small bit of education, I'm talking about we're not an education company, but I have owned 2 education businesses in the past, and we used to charge people for property advice, and good businesses, and there's about, 6 or 7 of these in New Zealand. So if you want a property education, you can pay for it. Okay, you won't get it from Auckland University or Canterbury University or Victoria University. You have to go to a private company who will charge you to be a long-term low-risk investor, a speculative investor. There's different types of education. Anyway, we don't do that because we think there's so much information out there on the marketplace now that you actually don't need to pay for an education. There's a free property education on our website. So if I go back to Property 101, this is Property 101. Most property markets are predictable because property is cyclical, and markets within markets occur, and long term, what goes up typically comes down, but on average it continues to climb at a steady rate. And I'm not talking property, I'm talking everything: shares, property, stocks, bonds, currency. They all go up and down, but steadily as she goes, inflation keeps things peaking along at 6-7% per annum on average over the long term. When I say long term, I'm talking 100 years. So we use what we call the property clock to predict where we think prices are at, where we think demand's at, supply is at. So if you look at the clock, 12 o'clock is a hot market, 1 It's where prices peak. And when you start going from 12 to 3 and then to 6, that's when there's oversupply. That's your global financial crisis scenario. That's your builder that's developer that's released 500 sections at once. And that typically brings economic theory into play. Prices fall, volumes drop, construction drops, and this has an impact on pricing. Same at the other end. If we're at 6 o'clock, moving to 9 and then 12, that's in an undersupply. There's, you're at the bottom. More buyers now come into the market. They start buying things up. Prices increase, volumes increase. Construction starts getting back. This is the typical cycle we see. And in New Zealand, it's every 7 to 10 years. And I've seen 4 cycles in my lifetime in terms of property cycles, from being a kid during the 80s and watching the impact of the 1987 stock market crash, right through to the global financial crisis in 2007, 2008, where we had a massive liquidity problem, and a few other what we call housing blips in between, dot-com crash, blah, blah, blah. There's a whole lot of them. But we can predict these cycles based on where a market's at. Now, if you look at Auckland, there'll be some parts of Auckland that are at 12 o'clock, but there'll be other parts of Auckland that are at 7, infill housing out west and south. So we use the clock as a measure to say, well, where is this market at right now? When I bought in North Lake, Wanaka, it was sitting at 6 o'clock, maybe 7. Now I'd say Wanaka's sitting at, 11 o'clock. The prices there, I don't believe, can go much higher. People's income has an impact on, people's income hold back prices. So, if I look at this, and we typically do this in the room, Wellington is beavering away at probably 9 to 10 o'clock, because I still think it's got quite a lot of legs in it. Very high incomes in Wellington, far higher than Central Otago. CBD Wellington's actually got higher income per capita than CBD Auckland. Auckland region still has the highest incomes in the country. However, if you look at Wellington in isolation, the affordability in that CBD is very high. So Christchurch has been sitting at 6 o'clock for a long time, and it's not sustainable. And, prudent buyers should buy at 6 and sell at 12 or reinvest at 12, but they typically don't. Well, prudent buyers do, but what I call retail buyers don't. And if you follow a retail buyer, if you take property advice from the newspaper or online, that's when you get into trouble, because this isn't rocket science. Property is actually quite straightforward if you've been around for a while, as is shares. If you've been a share trader for a long time, you pretty much know what you're doing. So I guess one of our goals is to make sure people don't make those retail mistakes or those cyclical mistakes, because it ain't rocket science. And I keep reminding our customers of that, to, do the opposite of what your gut's telling you if you're new, because your gut's typically following the retail mass newspaper, journalist-driven disaster waiting to happen. So yeah, listen to experts. So I'm just going to look at some historical stats to sort of give you an example of this. So the orange line's New Zealand and the blue line's Auckland. And if you look at the Auckland region, it's been plateauing now for a couple of years, which is good, because in the global financial crisis back in 2007, everything went back a bit. And it's not shown very well on this, because this is nearly a 20-year graph. But if we zoomed in on 2007 through to 2009, it actually had quite a decent drop in terms of the market. So New Zealand's national average, or New Zealand's median sale price, national average hit 700 grand today, I think, or yesterday. But if you look at our median selling price in New Zealand, it's sitting around about 600 grand. Auckland's sitting at just between 800 and 900. This is the median selling price right across the board. So we're talking about Auckland region. And if you look at the last 5, 6, 7 years, it's been growing at a pretty steady rate, and it slowed down in 2017. And that's good, because what goes up steeply doesn't typically come back evenly. And I think that the government's actually done quite a good job in Auckland with the Auckland Unitary Plan, with some restrictions on levelling Auckland out, as opposed to having some sort of spike that we saw in 2008. So the New Zealand long-term average, as you can see, is actually pretty steady. Now, if we look at each location, they typically follow the long-term average. Bright orange is Hamilton City, and the orange line's New Zealand again. So if you look at Hamilton City as the same thing, it's a conservative, it's a safe, it's a good location to be buying in. You know, $500,000 for its median selling price. Kauwhata. The Kauwhata is on our radar as a town that we see another Wanaka going on in. We see another Rolleston going on here because it's been touted as one of the 2 stops on the train between Hamilton and Auckland. Pocono's the other place. And it's been identified as a location that's good to build on. The amenities are strong with a lake. And one of New Zealand's largest developers is building 1,300 houses there. So again, we have some exclusive stock in that subdivision, and you can talk to our salespeople about that. But before you do that, talk to us about the research and the information we have, because we do a lot of research on location. And Kauwhata is literally halfway between Hamilton and South Auckland. And it's a location to keep an eye on over the coming years, but we'll talk about that later. So Wellington, purple line, New Zealand green, you know, for the first time in a long time, it passed the national average, and, you know, it's now sitting quite above it. And that's a lot of people moving to Wellington, a new industry. It's a funky place to live. They call it the Melbourne of New Zealand. You know, when I went there 30 years ago, I had 200 corporates and boring old government. It's a very different place now. And, you know, if we want another safe and steady city, it's Wellington. And it's had some pretty accelerated growth over the last few years, but that's really just catch up from 2008. You know, it was flat from 2008 until 2014. And, you know, not a lot of growth, and everyone poo-pooed it, and it was the earthquake city and blah, blah, blah. When Christchurch got the big earthquake, you know, it really gave people a different perspective on risk. And then Wellington, off the back of that and a few other economical drivers, became a city where people thought, yep, great place, good incomes, long-term, insurable events, earthquakes, let's get in there. And that happened in 2014. So let's look at Christchurch. So here's the anomaly, and it's very explainable. Christchurch has been flat since 2014-15, and it's not sustainable in our opinion. It is an economical powerhouse, and we think Christchurch is primed for growth over the following couple of years, or just years to 10 years. But we think it's going to start moving next year in 2020. And even if it doesn't, you can still get great deals in this city, far higher yielding than most cities. And when David talks to you about the numbers and what you should buy, Christchurch makes so much sense. But again, it's a complicated city. You really do have to know what you're doing buying in Christchurch, because there are so many new rules here with TC1 land, TC2 land, TC3 land. The second-hand market is so dangerous with what's called as-is, where-is properties. It's got a whole new set of property rules here, and we've been involved in Christchurch, in the Christchurch market, since the rebuild started in 2012, and you know, from that terrible earthquake in 2011, and you know, you need to know what you're doing in this city. But there's some fantastic opportunities here. And then if we look at Queenstown, the Queenstown market has been, like Auckland, it's been performing extremely strong. But again, you're going to be very careful in Queenstown that you don't end up buying in the wrong location, buying the wrong property type, because prices now are at the point they're pushing on the median selling prices over $1 million now, and things are starting to level off there a bit. But in saying that, we're still seeing properties sell at auction or not long after. Same with Wanaka, same story. A lot of growth ahead with Wanaka, with potentially international airport, or a much, much larger domestic airport because Queenstown's at capacity. So there's quite a lot of local knowledge going on in Queenstown, Wanaka, Central Otago, which we're keeping an eye on at the moment. But it's pretty hard to make investment numbers work down there right now unless you're getting into a new subdivision in a new town or in a new location in an existing town. And we're working on a couple of those at the moment that we'll hopefully have for the new year. So then the other one's Cromwell. It's part of, there's two golden triangles in New Zealand, Hamilton, Auckland and Tauranga, and Cromwell, Queenstown and Wanaka. And there's a whole bunch of economical reasons to invest in all of those locations. And that's the type of thing where when we sit down with you and say, hey, this property in Kauwhata or this property in Wanaka or this property in Auckland makes sense for you because A, B, C, and D. And these are the locations which we promote. So just to sum up the country, if you put it all in a graph here, and sorry for the resolution, it's a bit light. New Zealand's the black line, the All Blacks in the middle there. You know, Wellington, Tauranga and Auckland are the only locations above the New Zealand average, but if you add those places up, the population makes sense. Purple is Hamilton. It's steady, it's going up nice and steady. The red line, Christchurch, does not make sense. That can't continue. We just don't believe it will. And the blue line, Dunedin, again, nothing like the economical powerhouse of Christchurch, but it's seriously closing in on it, which to me just doesn't make sense. Hamilton makes sense because it's got an inland port. It's close to Auckland, it's close to Tauranga, it's part of it, it's in the Golden Triangle up north. Cromwell makes sense because it's in the Golden Triangle, but Dunedin pushing into Wellington, Christchurch levels tells me that Dunedin is not too expensive. It tells me Christchurch is too cheap. So we look at this and we bring it into a strategy. We bring it into, okay, what does this all mean? And we then make recommendations to our clients of where we see the market in 3, 5, 10 years' time. And all of the reports that we do with all of our deals basically follows this logic. And as I've said, Christchurch to us is an obvious place. And we don't say that lightly, and we encourage, in fact, we've got a promotion at the moment to get people to come and check it out for themselves because the light is at the end of the tunnel with the rebuild. You know, it's very, very advanced in the rebuild and prices have not kept up. So we don't think they're going to continue. We think they're going up. So you'll kick yourself if you don't get into Christchurch now versus in 2 years' time or 3 years' time. So let's just go to, again, property investing 202. What's my strategy? How do I do this? Now, we have a lot of this stuff for free, and you can spend a bit of time on our website and fill out some information, and we will give you a lot of free information. So property strategy 101. If you buy 5 houses in 5 years and hold them for 10 to 15 years and consolidate your income and debt, you can literally live off rents in retirement using average numbers. And when I say average numbers, I'm talking about basic entry-level investment numbers, because it's not get rich quick overnight. It's 10 to 15 year game. If you play 2 cycles, if you play in the market for 2 cycles and you buy on average 5 houses in the right location, you can literally live off rent in retirement. Now, if you've only got 3 years to do it or 5 years, it's a bit harder. If you've got 20 years, it's a lot easier. It all comes down to time and your age and your risk profile, your income. There's a whole lot of things, but property as a vehicle to live off in retirement has worked for tens of thousands of Kiwis. And if you look at it as a product or an investment product, the big stuff ups are when people get emotional and they treat property like their home and their castle, and we're gonna spend 500 grand on a renovation that should have cost you 100. You know, property is a business, and people don't unfortunately treat it like that, and that's typically where they get into mistakes. And one of the things we do is we take the emotion out of it and help clients. We help clients be good investors. So here's property 303. And this is basic property stuff. There's lots of books and articles you can get this stuff from. So property 303, you don't rush out and buy the house in Wanaka first. You don't rush out and buy the house on Waiheke Island. You don't rush out and buy the house in Queenstown. You don't even buy the one in Tauranga. You buy a boring property in Hamilton or Wellington or Christchurch. Even Wellington's hard to do now. You buy a boring property in Christchurch or Hamilton. And then you buy another one in those locations. And then you buy another one. And then you go and buy your capital growth one in Auckland. Or you buy your capital growth one in Moore. Or you buy your capital growth one in Wanaka or Queenstown. You get your cash flow properties first, because that's what David's going to talk about in a minute with regards to what banks look at. They don't want you, even though they'll lend money to you to buy a house in Queenstown or Wanaka, they actually want you to buy more cash flow property than capital growth, and they'll keep lending you money. And if you don't, they'll stop lending you money. It's that simple. And it's not just the banks. If you buy a whole lot of low yielding or low returning property, well, your income will be lower in retirement. And, you can have a self-funding, self-sustainable property portfolio if you do the basic things right. Because banks only look at three things: income, how much do you earn, how much money do you bring in, capital, cash, equity. How much equity, how much is your house worth? How much equity do you have in that? Your equity, your cash, or your value in your property is the next thing a bank looks at. And the third one's your character. Are you a good borrower? Will you pay them back? Do you pay your bills on time? And they look at your credit card statements, and David will talk about this in a minute, but they'll look at your spending habits, and they go down to the last dollar and cent now. So get used to that if you want. Property is a leveraged asset. You can borrow money to buy. You can borrow 80% of a brand new property and only have to put 20% in. So at 80% of the acquisition, the banks are going to put you through the mill. So don't go in there on a hope and a prayer. Go in there with a very, very good plan, with a strategy, and build a balanced portfolio. So I'm going to hand you over to David now. I'll come back later. And David's going to talk to you about the numbers.
Great, thanks, Campbell, and thanks everybody. So, quick intro for those who haven't come across me before. I started in property, getting on towards 30 years now. 30 years next year. Bought my first house to live in as a 19-year-old. I worked under a supermarket manager who already had a good portfolio by age 26. So he encouraged me to get started with property and not wait. I guess I've been in the property industry 20 years, in investment education, investment technology. I started renovating when I started building my portfolio in 1999 was my first investment property. Did lots of those weekends and evenings and putting lots of hours into renovating without counting the cost of your time, as you did. And have done a reasonable amount of trading and investing. I did some small development, but for a couple of years here, mostly 1 acre type sections to subdivide and build on, but took too long for my liking, and there's too many complexities and too many headaches and neighbour issues and council issues. So I decided that investing was a little bit easier, or investing and trading what's already been built by somebody else. If you've heard of Real Estate Investor, technology company, I founded that in 2006. Campbell invested and joined me in that business in the early stages. We built that up over a decade now. A decade as it was then. It listed on the Australian Stock Exchange at the end of 2015, and is one of the largest providers of technology tools to investors across New Zealand and Australia. So, straying out of property into property technology, I wouldn't recommend it. I think it's like one of those airline or winery jokes of, how do you make a small fortune out of technology? Start with a big fortune and start your own technology company. I'm a bit of a passionate dad. I've got three wonderful daughters that are all in their 20s, who one's already got their first deposit safe for their first home at age 22. One owns her own business, and another one's well on their way to getting into real estate. So that's a little bit about me. I'm a bit of a crazy sailor as well. I do a bit of stuff offshore, and I'd encourage you to think about, if you make money out of property, that's great. If you make money out of business, that's great. But don't fall into the trap of just chasing more and more money, putting more time into it, and not doing some other things recreationally to get yourself out into something you're passionate about. I do a bit of sailing, Sydney Hobart, solo Trans-Tasman race. I've crossed the Tasman 5 times now. So that's something I do just to keep myself passionate and keep recharging the batteries. So the Property Factory, as Campbell said, our big focus is providing resources online to our members. It's free to join the Property Factory as a wholesale member, as many of you know already. And we aim to put all sorts of resources, news, reports, podcasts, videos, and other information there that really helps you to understand the market without having to be a market expert. We try to narrow the content we provide to stuff that's highly relevant, so that you don't have to know everything about everything. And we provide services that help our clients understand what their capacity is or what their potential is as well. So, when we talk about matching, buyers and property, that's not some, cheesy Bailey's ad. That's us being very, very financial. And so when our definition of matching buyers and property is understanding what's your position, where are you the strongest? Is it income or equity? What do you need to do next to build whichever one is weaker faster? So if you're weak on equity, we want to make sure that we're getting you into opportunities where you're going to create equity faster, discounted real estate, early stage real estate, high growth areas. If you're weaker on the income side, where you're more likely to run out of debt servicing sooner with, property 2, 3, 4, or 5, then we'll focus on yield. So you'll still get good growth, but we'll make sure that you're focusing on yield and higher surplus cash flows from the get-go, so that those properties are funding themselves and you're not having to fund them and then eat into your debt servicing capacity. So that's really our focus. Apartments, townhouses, and house and land opportunities are the primary focus. And we really primarily we work with property investors, but more and more recently, with the growth of first home buyers being the largest segment in many of the cities around the country now, we work with first home buyers and what we call first home investors, people that are getting to real estate for the first time, who have lots of extra incentives these days, higher LVR lending, good interest rates, grants, etc., etc. So we've got a 3-step process. We recommend you always follow a process with real estate. It is just a process, and the more boring and predictable and repetitive that you make the process, the more likely it is to serve you well. And real estate is one of those places where you've got to understand the product, which is obviously the real estate. You've got to understand the macro environment, but it's also a very contractual process as well. And so having a legal brain is important, and getting the right legal brains around you. And it's a finance process too. So it's not one of those things where you try and sort of take shortcuts or cut corners, because you're likely to get burnt at some point. So one of the things we encourage all of our members to do when they're looking to invest in real estate or looking to build a portfolio they already have and take it to the next stage is to have us spend some time and put together an investment capacity report. It takes about 2 minutes to gather the information we need from you, sometimes a little bit faster. And then we go away, we spend a little bit of time, we come back with a detailed report. And it basically says, okay, based on where you're starting right now, this is what the next 10 years could look like for you, based on whether you move at a conservative pace, a typical pace, or an aggressive pace in terms of how quickly you leverage your income and your equity to acquire property. And so that's personalized to you, but just helps you to understand what's my starting point and where could I be. And so that's a free service to our members. You just request that through the website and we send it out to you. So the next step is when you get to the point where you say, yep, okay, I understand I could build a portfolio of 10 properties in 10 years or 5 properties in 10 years. And then you're at that point where you think, okay, that's great, but where do I start? There's a bunch of projects, there's different price points, yields and cash flows within those projects. Which one's right for me? And the challenge with the Property Factory is it's a bit of a lolly shop. We put all of the information on every project we have online and all sorts of extra due diligence and research data you can check out. But equally, for some people, it's a little bit overwhelming. So the property matching report enables us to then take and match 1, 2, 3 properties that best fit your position, and then really show you how that proratas out over the next 10 years and shows you the impact on your LVR or your loan to value ratio and your debt service ratio as well. So you can see how quickly that you can be back in the market for your next purchases, but also you can see that those things stay in check. And we do what's called a pressure test. And that's something that banks do but never tell you about and never tell you how the formula works. So we do an open and transparent pressure test where we say, okay, if the world changes and LVRs then go to 70% max or 60% max, what does that mean for you in terms of your portfolio and how quickly you can build it? We also pressure test interest rates and look at the impact on you at 4, 5, 6, 7%, because we all know that even though we're in a really low interest rate environment right now, that at some point, if Donald Trump stops creating havoc and Brexit settles down and North Koreans stop, threatening all sorts of crazy things, that the world might be a happy place eventually, and that we might have harmonious growth, and then interest rates might rise a little bit again in the future. So we show you how that would impact you based on the type of portfolio you can build in the next 1 to 2 years, and then how that pressure test works, so that you can see the impact. Because for most of us, we can sleep at night if we know the numbers make sense, and if we understand the numbers and we know there's contingency built in for a rainy day. It's a little bit like insurance, right? You don't take out insurance once the earthquake started. You make sure you've got it in advance. And so we make sure that we help you insure your risk and your planning and your position by doing that kind of work for you. So that's really when you get to the stage where you say, okay, now it makes sense. Now I understand. Now I'm ready to select a property. Yes, these projects are best for me, and stock within these projects makes the most sense. So there's the point at which we then, share the information with you, and then you can really dive into the website and fill your boots, really. We profile all of the stock exactly the same due diligence, same numbers, same rental appraisals, same independent valuations, so that you can see all the numbers and say, okay, if I'm a property investor, what's my cash flow? If I'm a first home buyer, what's it going to cost me? If I'm a first home investor, when I'm renting out maybe one or more of the rooms to a flatmate to help subsidize my mortgage, what do those numbers look like? And so if you haven't already, if you dive into any of the projects within the Property Factory website, into the members only section, you'll see all this information. You'll see data. You'll see all sorts of metrics about the suburb, the location, the strategy, and how the numbers make sense. You'll see market data. One of the things we always do, we always look at the last 20 years. Be very, very careful when you're looking at real estate and you're looking at glossy brochures. Some people will show you 2 years, 5 years, 7 years, whatever they think makes sense for selling the property. We show you 20 years every single time, no matter how good or bad the data is. We show you the size of the market, and we help you to see how fast the market's moving in terms of days to sell and what that looks like trend-wise. I've seen projects in the last 3 months promoted in pretty average, or let's say below average suburbs, and all the data in the marketing brochure refers to the city numbers or the region numbers, but doesn't refer to the suburb numbers. And that's because that suburb massively underperforms, and the developer's using creative marketing by using different data rather than the suburb that the development's in. So be very, very careful that you, first of all, you verify sources of data, but you make sure you double check that it's apples for apples. And we always put the market data sources on the website so you can see where we got the data from if you want to go check that out yourself. We integrate mapping, we integrate street view, and then we link off to some really, really cool suburb demographics at the One Roof website. So all that's linkable to from within the project. So again, you can do all your own background research. And sure, there's glossy photos and nice pictures, but remember, it's all about falling in love with the numbers, not the pictures. And so when you scroll down a project online, you'll see all of our assumptions detailed there so that you know the kind of costs we've assumed or built into the cash flow forecasts. On the left-hand side, all of those blue links are downloadable documents. They're all PDFs that allow you to then to drill into the detail and verify that for yourself. So what's different about the Property Factory is we give you all the information. We don't make you work for it. We don't make you ask us for it. We give it to you up front. And if you think about a traditional real estate agency that says, hey, 2 and 3 bedroom properties available from $400,000, contact me for more info. It's kind of like pulling teeth because they don't really want you to have anything more than you need or that you ask for. We just give you everything up front, including detailed cash flow analysis using 20-year averages in terms of growth rates, using actual verified independent rental assessments, and to make sure that we also work out the numbers based on borrowing 100% of the money, assuming you've got equity elsewhere. So that's what we do. So, and our team's here to help you with all of that stuff and help explain it to you as well. I just wanted to touch on finance because, as Campbell mentioned, if you don't get the finance part right, you just don't go anywhere. And for most investors we deal with, they could run out there tomorrow and pretty much point a gun at anything and buy it. And that's not hard to do. The issue you have is not buying the first one or the second one. It's how do you get to 5 and 10. And you only do that if you're strategic about finance and the type of properties you acquire in the early stages, the bread and butter, good growth, high cash flow, as opposed to the blue chip, prime, Coromandel, Queenstown, Auckland waterfront type properties where the yields will be terrible. They'll screw up your ability to fund the debt, but the growth will be great, but you might not get it if you can't hold on to the property. So on finance, one of the great things about New Zealand right now is the government is heavily incentivizing via LVR controls investors into purchasing new property. So that helps us in terms of leveraging our equity to 80% as opposed to 70% LVRs. It also means for the government is helping to sort of solve the housing shortage issue, where we've got a shortage of more than 50,000 dwellings right now, and unless more stock's being built, not just to replace the crappy old stuff that he's tearing down, but also population growth, then all that does is create more inflation, more price rises, more rent rises, and makes affordability really difficult. So when you're looking to get finance, most investors understand LVRs, or loan to value ratios. A lot of investors don't understand the DSR formula, or the debt service ratio formula. And that's quite simply the ratio of rent coming in to mortgage payments going out. So if I've got $1,300 coming in each month in rent, and I've got $1,000 going out in mortgage payments, that's a debt service ratio of 1.3. Why is it important? Well, from that surplus of the $300 in that example, the bank wants me to cover vacancy rates, repairs, insurance, property rates, body corp, that kind of stuff. And if you buy property that's well below 1.3, 1.2, 1.1, even 1, then all the bank's going to do is look for income elsewhere from you personally or from other properties to work out how you can afford those properties. So we always calculate the DSRs on all of our properties based on 100% debt. Most of our projects are 1.3, 1.4, 1.5, sometimes even 1.6. A couple of them are 1.2. So they're very, very healthy on the income side. And we do that deliberately because we know that for you to get from 1 to 5 or 5 to 10 properties, you've got to have the DSR in check, unless you've got one of those households that's earning, $200,000, $250,000, $300,000 a year, which most people aren't. Some people are, but most people aren't. You need a good broker. Banks will stitch you up. Banks want you to have everything in one basket. Banks will then put a foot on how fast you can go and cause you grief if you have a problem somewhere. So use a good broker who understands investors. Our team can help and refer you to a number of different independent brokers around the country that we use, who are just really good and really experienced. One of the big things that's happened in Australia that affects New Zealand is the Reserve Banking Inquiry that occurred last year. Given 4 of the 5 major banks in New Zealand are owned by Australian banks, it affects New Zealanders as well. And what happens now is mortgage brokers are required to be a lot more thorough in checking you can actually afford what you're purchasing. They don't rely on you declaring your living costs anymore. They check your bank statements, they check your credit card statements, and there's companies that exist now across Australasia that will analyze your bank statements, and they'll profile you from a risk point of view, not based on your repayment history, but based on the things you do. If you withdraw money from the ATM machine near the casino every Friday night, or near the TAB every Friday afternoon, that'll be a black mark. If you make all sorts of cash withdrawals of large denominations, that'll be a black mark. So just be careful. Big Brother's watching all of us these days, and just be aware that your financial DNA will either help you or harm you in future. So, think about these things as you go forward, because when you run out of finance, you can't do anything with real estate. So it's pretty important. So make sure it's aligned with your strategy. Okay, so on the finance front, if you need to maximize equity, because that's something you're a little bit short on, or you don't have big bucket loads of it, buy at discounts. But, in the last 4 weeks, we've had 3 different, maybe even 4 different projects of discounts between $17,000 and $30,000 on one project, around $40,000 on another project, 40, I think, to 58 on another project, all in the last 4 or 5 weeks. That's instant equity. That's independent valuations now to verify purchase price now is at a discount, so that when you settle that property, you've got equity in your portfolio, and you're partway to your next deposit for your next property. So look for discount opportunities. They're not always available, but often we come across developers who've got sales targets to meet, pre-sales targets to hit before they can get their project out of the ground, where they want to give away 3 or 4 or 5 at a bit of a discount because they know they can sell more at higher prices later on, where they'll pass those discounts on to the property factory. And because we've got an off-market member-only model, we can move that stock discreetly to our members who take advantage of the discounts. Nobody sees it on Trade Me, nobody sees it on realestate.co.nz. All those retail buyers flock there and pay retail. Our members pay wholesale. If you buy at early stages, as Campbell mentioned, the price simply goes up over time, particularly with off-the-plan apartment projects in the rising market, where lead time from selling initially to settlement can be 18 months, even 2 years. And so it's a no-brainer if you buy in a rising market and you pay $500,000 today, that if there's 5% growth this year and another 5% next year, well, now you've got $50,000 worth of extra equity by the time you settle that purchase. So that helps you to create equity by doing that. Buying locations that are 6 to 8 o'clock, where they're early stage in the growth cycle, like Christchurch is right now, but also sell out of low growth areas. If you've got equity tied up and it's going sideways in secondary towns or regional areas that aren't performing, don't just sit there for another 5 years. If there's not population growth, if there's not demand, if there's not infrastructure investment, if there's not industry setting up shop, creating new jobs, then take your medicine, sell out, take your equity and put it to somewhere where it's going to work better for you. On the servicing side, and again, probably 3/4 of our clients are stronger on equity than they are on servicing just because of the nature of the beast. So make sure you buy on good DSRs of 1.3 or higher. Look for extra rental strategy opportunities that will drive yield. So dual key examples, we've had those recently, dual income examples. The ability in some cases to put one on a long-term rental, one on Airbnb or on a short stay type structure. Have a good property manager that reviews rents regularly. Renting out by the room or renting out rooms if you're a first-time buyer can help. Obviously, short-term rentals help as well. If you get the right location, the right management strategy, it's not for everybody. But equally, sell poor-performing property. If you've got, I talked to somebody the other day, they own a $1.5 or $1.6 million property in Auckland, yielding $65,000 a year in rental income. Well, if you do the maths on that, that's about maybe 2%. It doesn't take a rocket scientist to figure out you can't get that property up and service debt at 4%. Because you'd be funding more than half of it. So if you've got low yielding property, this is a good reason to hold on to it. You can swap it for strong yielding property and still get growth as well. You don't have to always compromise. I often put this example up in when we do our live events to say, which would you buy, the one on the left or the one on the right? It's quite funny how many people put their hands up for either the townhouse or the apartment. And the answer is it's just not about the picture. Or the pictures, is about the numbers. So the question should always be, what are the numbers? Not what do the pictures look like? And retail investors buy on the pictures, wholesale investors buy on the numbers. That's how you build good portfolios. So wholesale membership is free. Sign up through the website if you haven't already. Take advantage of it. So Campbell, I want to hand back to you so you can touch on what's in the factory production line before we go to the Q&A session.
Okay. Can people hear me, or can you hear me, David?
I can, loud and clear.
I can hopefully hit the mouse button. No, I have no power.
Okay. So, I think you can kick it into gear.
There you go. Okay, so I look at properties all day, every week, every month. I love it. It buys my wife, Betty. I've got a 17-year-old that loves it, so he comes with me. And I've now engaged him as our drone operator, videographer, or video man. So this is just one of our listings, but in my opinion, it's one of the best that we've had for a very, very, very long time. And when I say best, I'm talking yield. And I'm picking capital growth, and these have been very popular. So these are brand spanking new 1 and 2 bedrooms. So they're actually not off the plan, but they are brand new. So we have literally come in as it's being completed. We've struck a deal with the developer, and the 1 bedroom units are 330 to 385, 2 bedrooms are 430 to 470. On a cash on cost return, some of these yields are up to 6.4%. Hence why we've been hit with this, or hit hard by purchases on this project. 6.4%. Now, in the world of money, that's over $5,000 per annum pre-tax cash flow. Pre-tax being before you get tax benefits. So the post-tax cash flow could be higher depending on your debt levels and the things you're depreciating. So this is actually cheaper to own than rent, which is crazy. But first-time buyers, unfortunately, they don't get it. So yeah, I see this as I see capital growth on it. It's been built by one of the largest builders in the country, being Fletcher's. Well, sorry, the largest builder in the country, being Fletcher's. And Fletcher's tend to over-specify, over-build and under-build. Things like a 2.7 metre plus stud height, double glazed windows with thermal glazing as well. They've got extra soundproofing on a lot of the units. They have up-spec'd the kitchens. They've got integrated joinery. They've also got, every unit has a heat pump / air conditioner, but every unit's also got an airflow system to stop moisture in the winter, because Christchurch can get pretty cold in the winter. I've never seen that before in a product this cheap. They're one of the best products we've seen, and I can't fault it. It's also on an old school site with huge old trees. That's just one of them you can see on the picture, and that gives such a nice outdoor effect in the common areas or the body corporate areas. And whilst you've got your own garden front and back, or in the ground floor units and balconies on the upper floor units, there's this huge open space with all this green area, and it's been done really, really well to be low maintenance, meaning low body corporate fees. It's also very unique in that it's in a mixed use complex, meaning it's going to have retail and commercial as well in the complex. And what that means is tenants will come here for that alone because they don't have to walk far or drive far to go to a shop. It's in the complex. It's built in part of it. So this is 2 Ks from Christchurch's CBD, and they start in the 3s for the 1 beds. It's just crazy. And we've looked at comparative product in the location, and nothing compares to it. Nothing. The nearest property is about 500 metres away, similar price, but there's no comparison in terms of street location, infrastructure, shops. I mean, there's a mall across the road from this complex. There is a boutique cinema in there. There is a couple of great bike shops, some fabulous bars and cafes, 2 Ks from the CBD. So, yeah, we think this is a cracker, and cash flow wise, we haven't seen it before. So we're doing a lot of visits with clients here at the moment. So we've got a promotion at the moment, haven't we, David, that we're refunding airfares or something. Do you want to give us a bit of feedback on that?
Yep. I'll cut to the promotional 30-minute segment, a 30-second segment. Yeah, so if you travel to Christchurch and you and your partner, you and your wife, husband, what have you, and spend if you want to, you can spend a couple of hours with Campbell and have a tour of Christchurch and the key locations, key infrastructure projects, see a bit of a contrast between some of the stuff we're doing, some of the other stuff that's not so good, to get an idea of the lie of the land. Then if you proceed and purchase anything with a property factory in Christchurch, we'll refund your cost of your economy airfares to Christchurch for 2 of you, because Christchurch has to be seen and to be understood. You can't, it's not as easy to do remotely, as much as we provide all sorts of mapping and reports and bits and pieces. When you see the lie of the land and you understand the parts that make sense, that are absolutely going to fly, and the other parts that aren't created equal, then that opportunity will help you.
Thanks, David. So, yeah, look, I can't sing enough praises of this project. I mean, all of our projects are great. They are. I mean, we put them through the mill. But price point, location, forecast capital growth, tenant appeal. The property manager I took through, or I've taken a couple through, but the main property manager that we're recommending for this complex, she agreed with me. She thinks it's the best complex she's seen since the earthquakes in 2011. There's so much bang for the buck. The courtyards for the 1 bedrooms are ludicrously large. It's got a locked bike shed. As I said, it's got it's on Colombo Street, which is just it's like Queen Street in Auckland, or Willa Street in Wellington, or Lambton Quay. I mean, it's just everything. It just ticks every box. But the quality of the product is just unbelievable. So tenants will not want to leave this complex when it's rented out. So that's 350 Colombo Street. We're very fortunate to have that project. And we think it's great. So check out it's on our website. You can come and visit it with me. I'm here all of next week showing people through. So take up that offer David just said, and yeah, hopefully we see you in Christchurch. How's he? Oh, there we go. So look, I'm always looking at new deals. We've got opportunities coming out. Pretty much, we haven't launched one apart from this one. We launched this one 3 or 4 weeks ago. We probably won't be launching another one before Christmas. And then in the new year, we'll have a couple of new projects coming away as well. But look, as David said, it's about matching your strategy to the deal. You're not the same as the person next door to you. Everyone has their own financial circumstances. The numbers dictate what you should buy, and we can help you make that decision. And not just the sales. We have a number of different professionals that we will point you towards, from finance to property advice, from a statement a statement of advice that will be signed off by an AFA if you want one. We'll send you to the right lawyer. the world of finance is very different for property investors than it is for owner-occupiers. So you need the right people around you to win in property. So, we have national opportunities. We don't launch deals every week. These are just some of the deals that we've been launching recently. These were some apartments in Christchurch, Kauwhata South in Auckland. We've got Lakeside Kauwhata. All of the stuff's on our website, and we do all the numbers, all the due diligence. And I'm going to hand you back to David now, because I guess he's going to wrap it up. And from my point of view, I'm going to stay online and do some questions. But one of the things we want to have with you at the Property Factory is a long-term relationship. Okay, and our goal isn't to sell you a property. Our goal is to be there with you as you build a portfolio. And if we're doing our job right, you'll keep coming back to us. And that's why we don't charge for an education. We don't charge you a property mentoring or coaching fee, because we don't think you need to pay it. We've got so much free information, or it's not free, it's cost us a lot of money, but we put so much information on our website that, and just doing due diligence on a deal, you'll learn so much. So that's how we teach people. We teach them by holding their hands and helping them buy their first or their fifth great investment property. So back to you, David.
Okay, thanks, Campbell. And so, in summing up, if you're not already a wholesale member, then just go join through the website, and it's free to join. You'll access all of the resources, and at that point, and if you are a wholesale member already or a platinum member, spend a couple of minutes, request the investment capacity report, because that's really where we can help, pull the lid off where you are right now and look at what your potential is, and then help you understand how to realize that. And we've got clients that we work with that invest through the Property Factory. We've got clients that have got all sorts of stuff they're doing in the background themselves directly, and a combination of those things. So our job is to help you grow your portfolio. Some of that will be through the Property Factory, we hope. Some of that will be being a sounding board at times when you've got other stuff going on that you're doing out there in the marketplace as well, or that you may already be tied up in. So we've got a lot of resources online, so take advantage of those. And again, take advantage of that Christchurch property tour with Campbell opportunity, because that can really help you get your head around the lie of the land. So what I'm going to do now is I'm going to pull up the Q&A box, and if you've got questions, make sure you send those through now. I'm going to go to the Q&A session, and we've got some questions sitting there, which I'm just going to read out now for Campbell to answer. If you've got other questions, submit those through now. Send those through the website. Just keep pumping them through the Q&A box, and we'll just keep going flat out, answering your questions until they stop coming through. So, Campbell, you want to talk about this first one here? A bit of a comment on Lakeside and Kauwhata, a reference to Kauwhata having a lot of new builds with the stock being built by or for Housing New Zealand. Do you want to just talk about Kauwhata and the mix, and how much of it's actually not just Housing New Zealand related stock?
Yeah, I mean, so first of all, the subdivision Lakeside is owner-occupier, landlord purchases in there. So I haven't heard any Housing New Zealand going into that subdivision, which is the subdivision we're talking about. If they are, that's news to me. In terms of Kauwhata Township, if there's some developers that are focusing on Housing New Zealand stock, that's news to us. So it's the first I've heard of it, and I don't have a problem with Housing New Zealand building stock for social tenants. We need that. New Zealand needs more housing stock across all categories. But in terms of Lakeside and being a project where you're going to have $1 million plus properties down to $400,000 to $500,000 properties, it's one of the best we've seen. So not quite sure where that's come from, but please feel free to email us, and we will look into it from just getting the facts out, because it's the first I've heard, to be honest. Good question though.
Okay, great. Ian's just asked, will a replay of this be made available? Yes, it's automatically recording right now, and Gabrielle, our marketing manager, will get the replay out in the next couple of days to anybody who wants to sit there and enjoy it all over again. Okay, some questions on capital. Good question here. What capital growth can we expect with the Colombo Street project in the next 2 years and 5 years? Question for you, Campbell.
Well, I'm actually expecting and I'm predicting a spike, because I think Christchurch, if I can use the easiest comparison, in 2014, Wellington had been flat for a number of years, and we had about 150 clients at our Christmas drinks, and I'd had a couple to drink, and I said to them all that they're all bloody mad if they didn't buy Wellington. And they said, well, how long is it going to take? And I go, I don't know, it's got to happen next year. And it did happen next year, but I picked it, then they got me to pick the month. I got it wrong by about 6 months. So I'm not saying I've got a crystal ball. I'm not saying I'm property god, but I am saying that Christchurch is not sustainable at the current prices. And when you get product like 350, you couldn't build that again for the same price. So, you know, we're benefiting right now in Christchurch, right across the board. And we won't just show you that. We'll show you a whole lot of projects in Christchurch, from house and land in the suburbs through to apartments to townhouses. So we're just using that as one example. But the prices here are just too cheap. The yields are too high. And that was what Wellington was in 2014. And it was so obvious to people that knew what they were doing. So it just didn't make sense. And I've got all of the same alarm bells going off right now. Christchurch doesn't make sense. The only caveat there is be careful here, because that's where we actually get people in the car and we take them around the city and show them the good and the bad. So you will get the pleasure of my company if you do come to Christchurch, because I'll give you a drive around with one of our team or a couple of our team.
Great, thanks, Campbell. Paul's asked, always been nervous about Body Corp costs and rising costs per annum. What do you think of Body Corp in your experience, and can you explain it in a little bit more detail?
Yeah, no, good question. I think body corporate fees are the most grossly understood costs in property. And most people that say that they think they're too high or scary don't understand them. Body corporate fees cover your insurance, the maintenance on the building, the long-term property maintenance. It does everything but the rates. And someone else manages them, someone else looks after them, someone else ensures that the property doesn't get run down. And the ignorance around body corporate fees is terrifying. Body corporate enables you to be hands-off. Your involvement in a property in a body corporate environment is so much less than if you are looking after a house. And, you know, people who have been doing property for a long time are all switching to body corporate environments as long as they've done the homework on the complex. You know, I wouldn't buy in a complex with swimming pools and gyms and lots of elevators, because they cost a lot of money to run. So that's not the problem. That's not a bad body corporate. That's just a designed development. You know, we looked at a property to buy the other day. It was down from like over $2 million to $1.5 million. I was really keen on it. But the body corporate fees to maintain the place were really high, because it was on a river, had a huge amount of open gardens, and it had a couple of lifts. So it was the body corporate fees and that stopped me buying something. But in terms of the way it was managed and put together, it was perfect. And I guess in terms of, you know, what you're buying for, your body corporate fees are often overestimated at the start, and that's good. It's the ones where they're too low where I think, well, hang on, I've actually worked this out properly. And that's where we always go with properties that have good body corporate managers who don't overestimate. Don't underestimate, they overestimate. And over time, you might find your body corporate fees coming down. And I think the 350 Colombo is one of those. I think they've overestimated the body corporate fees. And that's good. That means that there's more money to spend on the complex over time. I don't know if I answered that right, David?
Yeah, I think it's good. I think that's where people misunderstand that it's actually maintenance somebody's taking care of, that if it's house and land, you're doing yourself. It's easy to underestimate, particularly with existing properties, how much of your yield, your gross yields are eroded by repairs and maintenance. So I think it's, and again, body corps are controlled by body corp groups, which are made up of owners. So it's owners making decisions on spending owners' money on maintaining the property or the project for the greater good of the owners. So it's, you know, it's a pretty sensible thing and the right quality development. And yeah, my experience has been if the fees are too low, you should ask why, because often they'll bite you in the bum later on when they have to play catch up. If there's no sinking fund provision to have funds for a rainy day down the track. So good questions. Good answer. Thanks, Paul. Okay, so that's those are questions we've had come in so far. Any other questions before we wrap up the webinar tonight? Anything else at all? Just fire that through and we'll make sure we answer that. Oh, here we go. Ian, what's the overall availability of Colombo Street by number of bedrooms? Campbell?
That's a good question. I have to get the sheet out and look at it. There's more 1 bedrooms than 2 bedrooms. If you just give me a minute, I'll pull the file up and have a look at that. And give me 2 seconds.
Yeah, so while Campbell's doing that, the 1 bedrooms, ironically and completely not the norm, are the highest performers, with cash flows of $4 to $5 grand a year pre-tax, based on whether they're furnished or unfurnished. The 2 beds have got slightly lower yields, with cash flows of, I think, from memory, around $1,000 to $2,000 a year. And Campbell can update you on the mix in terms of what's available.
I just can't find the file, but about 70% of the complex are 1 bedroom, 30% are 2 bedroom.
Yeah,
and
that's correct.
2 bedrooms, 1 bathroom upstairs, big lounge living downstairs, and yeah, so it's all on our website. Sorry, I should have that in front of me, but I just don't.
That's okay. And Claire's asked on the same track, what's the rental prediction for Colombo, please? So yeah, the property investor cash flows for furnished and unfurnished for 1s and 2s are on the website that you can download. And the rental assessments and the rental manager that's done those assessments, that's all on the website as well. So dive into that detail, but they're great.
I do remember that. The 1 bedrooms are between $400 and $420 a week, and the 2 bedrooms are $420 to $460 a week. And I think those are light. I think those are light based on Christchurch rentals, but they're real. So property managers typically underestimate so that landlords aren't disappointed.
Yeah, it's a good point. And the people that we work with, they're specialist managers who only manage property. They don't sell, they just manage. And they specialize in these locations and these projects. And they're the ones that write the assessments are the ones that have to end up finding the tenants to match the rates they've estimated. So, it's in their interest to be conservative, because they know the disappointment if they don't stack up. Okay, so a couple more questions. Paul says, what do you think of lower Shotover area in Queenstown, Campbell?
I love Queenstown in general. Lower Shotover, yeah, depending on the subdivision. I'm not a big fan of Shotover country. I think Bridesdale is a brilliant subdivision. I think Lake Hayes Estate was ahead of its time. But again, it depends on what the product is. I think subdivisions need to be better designed in New Zealand in general. And I think, one of the criteria for us, like Ngaitahu in the South Island are a great land developer. The developer of North Lake and Bridesdale and Lakeside is a brilliant land developer. But not all land developers are created equal. And I drive through some of these subdivisions where the roads are too narrow, the streetscaping's average, the lighting's crap. And there's no covenants on the design and builds. You're seeing relocates next door to brand new property, and you're seeing crappy housing being next to $1 million property, and it's just, that stuff shouldn't be allowed. So subdivision selection is an art in itself, and again, we get really involved at that and look at the subdivision design and say, do we want to put our clients into that?
Okay. Good summary. And then Melissa's asked this final question right now. Is it best to use a property manager or look after the property yourself?
Great question, Melissa. I say to all first-time investors, if you are a first-timer and you live in the location, I think you should definitely manage it yourself, because there's a lot to learn about being a landlord and the rules and the regulations and the laws. And the best way there is to do it yourself. If you're out of town, then you've got to pay a manager. Now, I managed our properties for that first 10 years and went stir crazy, because at the end of it, we had something like 60 tenants, and I had a full-time job at the same time. So it's balancing your time, but you learn a lot being a property manager, and it's the horrible tenants that you learn more from, the painful tenants you learn more from. So I'm big on that. So good question.
Yeah, and also just on that, you know, when I self-managed my first 10 properties, and you know, they went pretty well, but 80% of my issues were maintenance related. The beautiful thing about new properties is you cut out that almost that 80% of calls that you would normally have, and that just really leaves you dealing with any other, you know, rental or real estate type issues. But when you don't have the grief over repairs and people chasing you for repairs and contractors that you're chasing, you know, it makes property management a lot easier with new properties. Right, good question, Melissa. Okay, well, those are all the questions we've had, and thank you everybody for attending the webinar. If no more comes through in the next 30 seconds, we'll wrap up and let you enjoy your evenings and take advantage of our team. We're here to help. Contact details are all available on the website, and all the project information is as well. And we'll send you out a follow-up email too with details of how to get access to the recording.
Yeah, I'll just one last comment from me. I'm looking forward to launching some new stock in different locations next year. But that 6 o'clock, buy at 6 or reinvest at 6 is so real. We're under pressure as a country. We're growing. We're going. More and more people are coming in, and you know, we're not keeping up. And not all subdivisions and property is created equal. Buy on the fundamentals and come and check us out in Christchurch. I mean, we'll be doing road trips around the country every time we launch a new project next year. And by all means, come to those if you can. They're hard to coordinate because, you know, we typically do them on a Friday. You have to take a day off work. But, you know, if you're buying a $300,000, $400,000, $500,000 item, you should take time out and come and see it, which is why we're encouraging you to come to Christchurch and check out the market here, because you know, they released the details for the new sports metro complex the other day, and it's just insanely amazing. The covered stadium details will be out next year. The new library's finished. The convention centre's 3/4 finished. The city is coming on stream like nothing I've seen before. And I just think the timing is so good here. Hence why I'm making myself available all of next week to give people a road trip. And we'll be doing it together. You'll be in the car with other investors. If we get enough people, I'll probably put a little minivan on. So yeah, I'd strongly encourage you to get down if you can and liaise with our team. So that's me, David.
Okay, and just one last one's slipping through here to the goalkeeper. Eddie's just asked, actually 2 more questions now. He's just asked, hi, could I ask what you feel about Hanley Farm in Queenstown, please?
Yeah, no, I know Hanley Farm like the back of my hand. Another great subdivision, and I would say great because it's in a very good location. It's been built properly, and if I look at it from a proximity to the new CBD of Queenstown, when I say the new CBD of Queenstown, I'm talking about Remarkables Park. You can bike there. Now, not everyone will bike there because there's a bit of a hill in between. It's not a massive hill. So proximity to Queenstown is really good. And the new bridge has changed that whole southern aspect of Frankton and the that part of Queenstown. So, you know, but again, prices have shot up in Hanley's Farm. I mean, I can't believe some of the resales I've seen in there. And I can't believe some of what, you know, you got to spend $1 million to get a new house in there now. So, you know, that's the only thing I'd be careful of. But nothing wrong with the subdivision. It's a great subdivision.
Okay, and Paul just asked, are you there over next weekend? I'm not. I think that might be in reference to Christchurch. Paul, you might have to give us some more information. Are you thinking of visiting Christchurch next weekend? I wasn't.
Yeah, just email one of the team, Paul. We'll liaise with you.
Yeah. Okay. Yeah. Christchurch, Paul says. Yeah. So Campbell's based in Christchurch, where our head office is, Paul. So he's always there. So yeah, just drop us a line. Eddie says, thanks so much. Very informative webinar, and we look forward to talking to you more about Christchurch. Cool. Well, thanks everybody. We'll wrap it up there. But yeah, take advantage of our team. We're here to help, and we look forward to seeing you on the ground somewhere. But definitely in Christchurch in the near future, given all the action opportunity down there.
Thanks, guys.
Thanks, guys. Thanks, Campbell. See ya.